There is a phrase that Ernest Hemingway used to describe bankruptcy. He said it happens two ways: gradually, then suddenly. The same pattern describes every major transformation in financial history. The system builds pressure quietly for years. The signals appear but get dismissed. The mainstream stays focused on the visible surface: the stock prices, the headlines, the daily volatility. And then one day, the pressure finds its release point, and the transformation that seemed distant becomes immediate. Right now, 5 separate pressure systems are building simultaneously in the global financial system. Each one on its own is significant. Combined, they form a chain reaction with a very specific destination. A destination that most crypto investors have been discussing for years without fully understanding the macro mechanics that lead there. The chain starts with oil. It runs through inflation. Inflation runs into Japan. Japan runs into the carry trade. The carry trade runs into a global liquidity shock, and a global liquidity shock runs directly into the question of which settlement infrastructure can move trillions of dollars fast enough to matter when the old system fails. That question has an answer. It has been built. It has been tested. It has been deployed across more than 60 regulatory jurisdictions, and it keeps appearing at the intersection of every major financial system that is preparing quietly for what comes next. Today, I am going to connect every domino in that chain, clearly with the math, so that when the mainstream finally looks up from the daily price chart and asks what is happening, you will already understand the structure underneath it. Welcome back. I'm the calm analyst. No noise, no panic, just the architecture. Let's go. Let's start at the beginning of the chain, because most people jump to the crypto part without understanding the macro mechanics that make it inevitable. Oil is not just an energy commodity. It is the most powerful inflation driver in the entire global economy. Energy prices feed directly into transportation costs, manufacturing costs, food supply chains, and consumer prices across every major economy on Earth. When oil rises sharply and stays elevated, inflation follows. Not immediately, but with the certainty of physics. The cost of moving goods, producing goods, and delivering goods all increase simultaneously. And that inflation pressure does not stay contained in the energy sector. It spreads. Right now, the Strait of Hormuz, the narrow maritime passage through which approximately 20% of the world's oil supply flows, is experiencing escalating disruption. Tanker traffic through the strait has dropped dramatically. Major shipping companies have rerouted vessels or suspended operations. Energy traders are pricing in supply risk. Crude oil is breaking out. Analysts across energy markets are already discussing the possibility of oil moving back toward triple digits if the disruption continues. The White House has sent a specific signal: short-term pain for long-term gain. In macro terms, that kind of messaging from policymakers means one thing: they are preparing markets for disruption. They are signaling that the turbulence is expected, anticipated, and considered acceptable as the cost of a longer-term objective. That is not reassuring language for markets. That is a warning dressed in calm framing. Energy disruptions rarely remain isolated. They spill into currencies, trade balances, central bank policy decisions, and capital flows. And the specific economy that sits at the most critical pressure point in this chain is one that most people in the crypto community have discussed only superficially: Japan. Here is the mechanism that connects oil in the Strait of Hormuz to trillions of dollars in global capital movement, and it runs directly through Tokyo. Japan imports nearly all of its oil. Every barrel that flows through the Strait of Hormuz toward Asia includes a significant Japanese allocation. When oil prices rise, Japan's import costs rise immediately. When import costs rise, Japan faces inflation pressure, the kind of imported energy-driven inflation that is particularly difficult for a central bank to manage, because it cannot be solved by domestic monetary policy alone. Now, here is why that matters for global finance in a way that dwarfs the energy story. For over 30 years, the Bank of Japan maintained interest rates near zero. That policy was designed for domestic economic reasons, but it created an unintended consequence that became one of the largest liquidity engines in the history of global capital markets: the yen carry trade. The mechanics are simple. Borrow Japanese yen at near zero cost. Convert it into higher yielding currencies: dollars, euros, emerging market assets. Deploy that capital into US treasuries, global equities, real estate, and digital assets. Earn the spread between 0% borrowing cost and whatever the destination asset yields. Repeat at scale. Over decades, this trade accumulated an influence estimated in the multi-trillion-dollar range. Analysts have estimated that approximately $2.3 trillion in foreign-held U.S. treasuries alone are connected to carry trade positioning. The full scope, including equity exposure, real estate, emerging market debt, and digital asset allocation, is larger and not fully quantifiable. But here is the structural vulnerability that everyone carrying this trade understands intimately. It only works as long as Japan keeps rates near zero. The moment the Bank of Japan raises rates meaningfully, the moment borrowing yen is no longer cheap, the entire trade must be unwound. Investors sell whatever they bought with the borrowed yen. They convert proceeds back to yen to repay loans. They do it fast because everyone in the trade is watching the same signals and moving toward the same exit simultaneously. That is the reverse carry trade. And when oil forces inflation into Japan and Japan's central bank responds, even modestly, the unwinding begins. Not gradually, violently, because the trade has been building for 30 years and the exit is a single door. Let me run the math on what that unwinding means for the global financial system, because the numbers here are not abstract. $2.3 trillion in foreign-held U.S. Treasuries potentially shifting position. That is the conservative institutional estimate. Add the equity exposure, add the real estate exposure, add the emerging market debt that was funded by cheap yen. The full scope of capital that needs to move back to Japan out of dollar assets through currency conversion across borders during a carry trade reversal is a number that strains the settlement capacity of the existing financial infrastructure. The correspondent banking system that handles most cross-border settlement today was not designed for this scenario. It operates on settlement windows measured in days. It requires pre-funded Nostro and Vostro accounts in every corridor, an estimated $27 trillion in idle pre-funded capital sitting frozen in buffers just to make the existing system function during normal market conditions. Under a sudden $2.3 trillion liquidity reallocation during maximum market stress, that system does not just slow down, it becomes the crisis. This is the moment where efficient settlement infrastructure stops being a nice-to-have and becomes a survival requirement. When trillions of dollars need to cross borders simultaneously, in seconds, without the pre-funding requirements and correspondent bank intermediaries that add days of latency to every transaction, the financial system reaches for whatever can actually handle it. Former CFTC Chairman Christopher Giancarlo said it plainly. Banks need crypto regulatory clarity more than crypto companies do. Not because banks love innovation, because they understand their own infrastructure well enough to know it cannot handle the next liquidity shock without something faster underneath it. Cross-border transactions that take days, settlement systems requiring massive pre-funded liquidity pools, correspondent networks introducing friction at every step. These are design failures that are tolerable in calm markets and catastrophic in stressed ones. The infrastructure that eliminates those failure points has been built. It has been tested. It settles in 3 to 5 seconds. It costs fractions of a cent per transaction. It processes up to 1,500 transactions per second. It requires no pre-funding and no correspondent bank intermediaries. It operates 24 hours a day, 365 days a year, without market hours, without clearing windows, without the latency that turns a liquidity event into a systemic crisis. That infrastructure is the XRP ledger. Now let me stack the institutional evidence, because the domino theory is not just a macro argument. It is being validated by where the world's most sophisticated financial institutions are quietly building right now: Dubai. The Dubai Financial Services Authority inside the Dubai International Financial Center has granted Ripple full regulatory approval to offer cross-border crypto payment services. This is not a sandbox license. It is regulated infrastructure operating inside one of the world's most important international finance hubs, and it activated immediately. Real-world asset projects launched on the XRP ledger following that approval, a $280 million diamond tokenization using Ripple custody infrastructure. Dubai's land department exploring the tokenization of real estate title deeds. Combined real-world asset initiatives connected to the XRP ledger in the region have already surpassed $2 billion. That number is not the point. The trajectory is the point. These are regulated deployments inside a financial center that handles significant global capital flows. When financial hubs build regulated infrastructure, they build it for the volume they expect, not the volume that currently exists. Ripple now holds more than 60 licenses across multiple jurisdictions: Asia, Europe, the Middle East. Each license is a regulated corridor. Each corridor is a route through which institutional capital can flow using XRP as the bridge asset without compliance risk. The regulatory footprint has been assembled quietly over years. 60 jurisdictions means 60 markets where an institution can use Ripple's infrastructure without asking its legal team whether it is permitted. The answer is already documented. The DTCC is deploying its tokenization service this year with Hidden Road, acquired by Ripple, integrated into its back-end infrastructure. The Royal Bank of Canada, Bank of America, Bank of Tokyo Mitsubishi, Santander, Standard Chartered, CIBC, and Westpac are confirmed governance partners. TCS BancS has Ripple in its Quartz Gateway architecture, serving $40 trillion in securities annually. The Bank of Canada ran a tokenized bond pilot. MasterCard is piloting RLUSD settlement on the XRP ledger. And the 1,700 NDAs from the Ripple SEC lawsuit represent 1,700 additional parties, banks, governments, institutions, whose relationships with Ripple are real and documented but not yet public. 1,700 switches wired in and waiting. Here is what the historical pattern tells us about the timing of what comes next, because this particular pattern has repeated throughout financial history with striking consistency. Digital payments accelerated once smartphones reached mass adoption, not gradually, but suddenly, crossing a threshold where the infrastructure that had been built quietly for years was suddenly necessary for mainstream behavior. The transition from physical to digital commerce looked slow and then looked obvious in retrospect. Streaming replaced physical media once broadband reached critical scale. The infrastructure had been built, the content was available, and then one year the numbers crossed and the old system was irreversibly behind. The 2008 financial crisis did not create new financial technology. It exposed the friction in existing systems and made the development of alternatives urgent rather than theoretical. The crisis accelerated what had been building. Every major financial transformation follows the same pattern. Infrastructure builds first. Adoption looks slow from inside the building phase. Then the trigger arrives, the stress event, the threshold crossing, the moment when the old system's limitations become undeniable. And adoption accelerates from slow to sudden without a visible intermediate phase. The XRP ledger's infrastructure has been building for over a decade. 60 regulatory licenses, 1,700 NDAs, 7 governance banks spanning 5 continents, DTCC integration, MasterCard pilot, $2 billion in Dubai real-world asset deployments, $16 trillion in G-Treasury payment flows being connected to on-chain rails. The infrastructure phase is not approaching completion. It is already substantially complete. What has been missing is the macro trigger, the stress event that makes the question of which settlement infrastructure can handle the load not a theoretical future consideration, but an immediate operational requirement. Oil at historic disruption levels. Japan facing imported inflation. The carry trade under pressure from 3 simultaneous directions. A White House signal of short-term pain as acceptable cost. $2.3 trillion in potentially unwinding carry trade positions. The trigger is forming. Let me speak to the people who have been patient through years of slow progress and sideways price movement, because I want to be clear about what this moment actually represents. The frustration of the past several years was not evidence that the thesis was wrong. It was evidence that the infrastructure phase takes time. Systems do not get built overnight. Regulatory licenses do not get approved overnight. Governance partnerships with the 4th largest bank in the world do not get structured overnight. The 1,700 NDAs were not signed in a week. The DTCC integration did not happen in a quarter. The Dubai regulatory approval was not a single meeting. Every one of those developments required years of patient, methodical work. Work that happened without headlines, without price movement, without the market recognizing what was being assembled. And now it is assembled. The rails are in place. The licenses are secured. The institutional relationships are confirmed. The regulatory environment in the United States has inverted from hostile to supportive. What was missing was the macro environment that makes the infrastructure necessary rather than optional. Institutions adopt new settlement rails when the old ones fail them at scale, not when someone explains theoretically that the new rails are faster. The necessity arrives with the crisis: oil disruption, inflation pressure, Japanese monetary policy stress, carry trade reversal, global liquidity shock. Each step in the chain increases the urgency of the question that XRP was built to answer. How do you move trillions of dollars across borders instantly when the existing system cannot handle the volume? Slowly, then all at once. The system has been building slowly for a decade. The trigger for all at once is forming right now. Here is everything I want you to carry forward from today. Oil disruption at the Strait of Hormuz is removing approximately 20% of global oil supply from stable shipping routes. Japan imports nearly all of its oil. Inflation pressure in Japan creates pressure on the Bank of Japan's near-zero rate policy. The yen-carry trade, estimated to influence multi-trillion-dollar global capital flows, only functions while Japanese rates stay near zero. If rates rise, the carry trade unwinds. $2.3 trillion in foreign-held U.S. treasuries alone could shift position. The correspondent banking system was not built to handle that volume at that speed under that stress. XRP was built for exactly that scenario. 60 regulatory licenses, 1,700 NDAs, 7 governance banks, DTCC integration through Hidden Road, MasterCard RLUSD pilot, $2 billion in Dubai real-world asset deployments, $16 trillion in G-Treasury annual flows being connected to on-chain settlement, full regulatory approval in the Dubai International Financial Center. Infrastructure builds first. Adoption follows when necessity arrives. Necessity arrives when the old system fails under stress. The stress is forming. The question is not whether the chain reaction happens. The question is who understands the destination before the mainstream connects the dominoes. Comment domino below if you followed this chain all the way to the end. I want to see who is watching the macro mechanics, not just the price chart. Stay patient, stay rational. The transformation happens slowly. Then all at once. We don't wait for the future. We plan for it.